Have you ever faced a sudden, overwhelming financial emergency that made you wonder if there was any way to access your hard-earned retirement savings early? Hardship withdrawals from retirement funds, such as a 401(k) or 403(b) plan, are specific, strictly regulated provisions that allow you to tap into your savings before retirement age. The key is that these withdrawals are allowed only under very limited and defined circumstances, typically without the usual 10% early withdrawal penalty. However, it is crucial to remember that the amount withdrawn is still subject to ordinary income tax. The reason these rules are so strict is to protect your long-term financial security and ensure your retirement funds serve their primary purpose, funding your life after you stop working. The Internal Revenue Service, or IRS, defines a hardship as an immediate and heavy financial need where the money cannot reasonably be obtained from other resources. This is not simply for convenience. It is for genuine, pressing emergencies where failure to address them would cause severe financial distress. These rules prevent people from depleting their retirement savings for non-essential expenses, which could leave them vulnerable later in life. To qualify for a hardship withdrawal, your situation must fall into one of the IRS-defined safe harbor events. These include expenses for medical care, costs directly related to the purchase of a principal residence, tuition and related educational fees, payments necessary to prevent eviction from your principal residence, burial or funeral expenses, or certain expenses for the repair of damage to your principal residence. Each of these categories has specific documentation requirements to prove the immediate and heavy financial need. When considering a hardship withdrawal, your first step is to contact your retirement plan administrator. They will provide you with the specific forms and outline the detailed documentation required for your particular situation. You will need to demonstrate that the amount requested is not more than what is needed to satisfy the financial need, and that you have no other reasonably available financial resources to meet that need. This is not a loan that you pay back. It is a permanent withdrawal that reduces your retirement nest egg. The funds are generally distributed as a single lump sum payment and are subject to income tax in the year of withdrawal. A crucial detail to understand is that while the 10% early withdrawal penalty might be waived for qualifying hardships, the amount you take out is always considered taxable income. This means it will be added to your gross income for the year, potentially pushing you into a higher tax bracket. Furthermore, your plan might prevent you from making new contributions for 6 months following a hardship distribution, further impacting your long-term retirement savings growth. These are significant considerations beyond just meeting the initial qualifying event. Ultimately, while hardship withdrawal rules provide a critical safety net for truly dire circumstances, they are designed as a last resort. Understanding these precise requirements and the tax implications empowers you to make informed decisions for your financial well-being. It is always wise to explore all other financial avenues before considering early access to your retirement funds, preserving your future security whenever possible.